Beautiful.
Hello, trader friends. Welcome back to the Tom and Tony podcast. And I know you're expecting different Tom and Tony, but we are the Tom King and Uncle Tony show, the best trading podcast on the internet. Hey, Tom, how are you doing?
I'm doing fantastic, Tony. How are you? It's been a couple weeks. We've both been really busy, so it's good to get back on this again.
Definitely, definitely. My apologies to everybody out there. We haven't been able to catch up. I've been traveling, I've been working, and I've been doing home repairs. And so, tell us, what did you do on the last month, Tom?
Yeah. So I've been doing the same thing. So I've been traveling. I'm remodeling my house, and so traveled. I was in Florida last week. Played a little pickleball while I was there. Didn't play any golf, but I played some pickleball. And by the way, beat a couple of 20-somethings. My wife and I did that thought they were all that in a bag of chips. So
Good for
you don't
you.
have to be the youngsters out there to play pickleball anyway. So enjoyed some pickleball and enjoying the market. So I'm right now a few points from an all-time high again in the account. So we've been doing great on the trading front. And the nice thing too, I think, about the style for me and probably a lot for you is
Yeah.
I don't have to watch the market every day. So I
No,
can go on vacation. I can go play some golf. I can go do something. I don't have to really stare at the screen all day and try to day trade and scalp my way in and out of things. I just take a quick peek, and if I'm good, off I go.
that's great. During the last month, I you won't believe this. So last Sunday, I played my second pickleball tournament with a friend of mine who's a retired Navy SEAL, and we won the tournament. And it's a round robin, and we won our six matches. And I was able to play golf last Saturday here in Aviara. I used to play golf every day, and I played. Aviara is a beautiful course here in north of San Diego, and I had a goal of getting 4 pars, but I got 8 pars, and but shot 88, of course. And I can barely. I
Oh,
mean, I
it's all
I
good.
was hitting the ball horribly, but when you play golf, you can scramble and make putts, and so 8 pars is not bad for
No, not at all.
even at a resort course like Aviara, right? So it's
Yeah.
so it's not bad. And hopefully today they'll be re-roofing my home. So and it's been 2 weeks and they haven't finished. And hopefully they come in
Oh,
today
boy.
and finish the last part of the repair. Re-roofing a house is a big thing. Believe me, it's
Yeah,
a pain
well,
in the
I'm getting quotes on it right now. So that's the next thing. After I've remodeled the entire first level, every single room has been redone, the kitchen, and now they're telling me, yeah, you need a roof. And it's been 29, almost it's been 30
Yeah,
years basically. So
mine
it's
too.
it's overdue.
Yeah. The good thing is I won't be here for the next roof. I'm probably gonna be gone. Someone else is gonna, but I'm gonna warn you. They give you a quote for the roof, right? And I have a flat roof, and then I have those like Spanish tiles, both. And whatever they tell you, maybe add 50%, because when they open up things, hey, this wood is rotted, this is termite damage, this thing has water damage, this the air. I
Well,
mean, just get
I'm
prepared
expecting it.
for 50% more than what they said originally.
I'm expecting it. I'm expecting them to replace all my gutters with larger gutters and gutter guards and all kinds. I'm expecting the worst.
Actually, today the last part is the stainless steel gutter that we're putting in to last forever. So you know what's coming. Good,
I
good.
know.
So
Hey,
now back to
before we move
trading.
on,
Oh yeah, yeah,
real
yeah.
quick too. You were last we talked. You were going to play some golf with Sosnoff a couple weeks ago. How'd that go?
Well, we that's coming up soon.
Oh,
That's
he
coming
hasn't
up.
been down to there yet.
No, not yet, not yet. So I'm going to host Tom the at the end of August, and he's gonna give a. He was invited to be the key speaker at a huge investing event in Mexico City, and I already
Oh,
bought
good.
the a huge red carpet all the way from the airport to my house. So a 7-mile red carpet. So you know, so I'm. It's gonna be Can't wait to have
It'll be
Tom
fun.
there. Yeah, I was able to snatch some reservations at top restaurants like Pujol. Pujol is ranked, I think, the number 7th restaurant in the whole world, and it's a high-end Mexican restaurant, which I've only been there once, and it's going to be my second time. And I'm going to take Tom probably on a taco tour of Mexico City, because Mexico City tacos are very famous, and they're not like American tacos, but they're delicious. And I want him to try different styles. So it's going to be a fun week. Finance, golf, food. So I can't wait. Can't wait for that.
Perfect. Good.
Excellent. Now back to trading. I'm looking at my account right now, and believe it or not, now my account is at all-time highs right now. But it wasn't like that 3.5 weeks ago. So 3.5 weeks ago, I had a couple of problem childs. I do my 120 trade, and then I think I showed it to the upside last time we were here, and I said I hadn't had a loser yet in 2 years. And guess what? Just after the podcast, the market ripped up like crazy. So I had what I do with the 120 to the upside is I take profits on the vertical, normally 75, 100 wide, and then I roll the call to the following expiration to keep the dream alive. And to hedge that naked call, which I hate naked calls, I sell a put and make it like a strangle to add a little bit of extra theta to help me break even. And just to give you an idea, one of the calls I was losing like $150 on, which is a lot, on one single call.
Mhm.
And on the down move, I had a GTC to close it. So when I have a losing trade and I convert it into a strangle, I try to look at the overall P&L, but I'm also focused on my break even on the call side. So when I was able to break even on the call side, I closed it down and I was left with my hedge on, my naked put hedge on. And then the market luckily bounced up and I was able to close both sides. And so it was pretty scary for Uncle Tony, that last up move, even though I was very small. I only had two short calls, but two short calls, I was costing me, $30,000-$40,000 on two stupid trades. So it was very painful for a little bit. And luckily I was able to take him off for break even and make a little bit of money on my hedges. So that's how I survived the last month.
So I know you're the death before debit. I'm
Yes.
death before naked calls. So
Yep. Me too, except for the 120.
Can't do it.
Yeah, the 120 has a naked call component, at the end. So I made the money on the vertical, but I don't like to take losses. I know I should learn from you. I don't take losses. I especially if I put in a very solid trade that I think was solid, and because I think the market will maybe revert back. But on the call side, sometimes it never reverts back.
Right.
And
I'm very do strangles. So I have strangles on. So there's naked calls and strangles. So yes, I'm sure somebody's going to write in and say, "Hey, you do strangles, so you're selling naked calls." Yes, I am, but they're pretty far out of the money, and I'm pretty picky about what underlyings I put those on. So I don't do it typically in ES much because the drift up, I don't want to deal with it. I put them on in futures that typically oscillate, stuff like oil or bonds. Or anything that doesn't have giant moves and oscillates up and down. Gold, it can go up over time, but it has its moments where it's up and down. So I'm just picky about where I put them. So
no, good for you. I should have listened to you, because I was really, I forgot how uncomfortable it is to have those naked calls. But luckily, I got really lucky on the down move, and I was very disciplined to close them out because when you have a big losing trade, then you're at break even, then you become greedy and say, I'm going to hold on to make a profit. And I learned, no, if the trading gods are letting me out at break even, I'm gone. And I was able to be disciplined, at least take my break-even money, and then I was left with more units than I really wanted to the upside. And but then luckily, the market bounced and I was able to close them. So after all the little stress, everything worked out fine, and now the account is at all-time highs. And I have almost nothing on. I have 16% of my buying power utilized, so I have 85% free. So right now I'm
Wow.
pretty light. I'm pretty light.
I'm still at my 50%, but I don't really get much above that. It really doesn't get. I'd like to keep it working, so I keep it. But I'm gonna continue on your trading gods point. So last week, I put out some videos last week, and I started off this week on them. A lot of people with a little selling last week. I mean, the market was down, what, 3.5% or something, and you would have thought that the world was ending for people last week.
Exactly.
So if the world was ending for you, not you, Tony, but you watching this last week, and you were not able to sleep with the market down 3.5% in 4 days, you're way too big, folks. And the trading gods are looking at you today saying, okay, dummy, if you were too big last week, the market's up 87 points today, or I don't know, at least on the ES, the S&P's up 87 points.
Yep.
Today they're telling you, okay, dummy, this is a good day to close all of those too big trades and get out and get back into something that's a better sized trade maybe tomorrow. I mean, a huge update today is bailing out a lot of people who are not sized properly. So I just want to point that out, that, hey, sometimes you don't get this opportunity. So if you took some losses last week and you were uncomfortable, you're being given a gift this week and today that, hey, fix your account, get sized properly, okay, and now get back into them. You're a great example. You're at, what, 15% buying power.
Right.
Okay, so you've got tons of dry powder. Let's see what happens if the market goes down. You got lots of opportunity to take advantage of stuff. And the market's been overbought for quite a while. At least the RSI has been overbought. I mean, everything's overbought. It just keeps going up, which is a great idea, great thing to take in mind, that if you are way too heavy on long trades, then in an overbought market, you might want to back it off a tad. So,
definitely. That's a great point. And I was thinking of you on the down move, and because I haven't been tested when I have 50% of my buying power on, and I wanted to ask you how from your net lick, a move like that, what percentage of your net lick was affected? Were you down 1, 2, 3, 4, 5% on your account on the temporary down move? I was just curious how much money the net lick went down on
so
that
I was
down
down when the market was down about 4% or 3.5%. I was down about 2.5%.
Okay, so not bad.
Of the total portfolio. I mean, so it was really nothing, and that's over a couple day span, and that's 2.5% off of basically an all-time high in the portfolio. So it really was not much at all, and I didn't see a huge increase in my buying power. I think I was at 50. I made in fact, I can tell you right now.
Okay.
It was really last Wednesday. Was the bigger down day, and I went from really 55%. So I was at 55. I was just a little heavy to 62%, and then it's backed all the way back down to 51% today. So it really didn't get too out of control at all. I mean, it went to 60%, but that's me at 50%.
Right.
And I was sitting at 55, went to 60, and then back down to 51 today without really closing much. I took one loss and I had one gain on it, and that's really it. The only loss I had was a ratio spread on oil.
On
because
oil, not
has
even
just been
on
dropping like a rock. So.
Yeah. So not even on SPX.
No, nothing in SPX. Everything in SPX is in beautiful shape. I run mostly those 112s, so Those are in great shape. I didn't have a whole lot on. I did have a few hedges on, and I also have some just naked put plays on, but they're all decaying nicely. I'm not over allocated on it. In fact, when I look on the Tasty platform here, and one thing I love is the allocation thing. So if you go to your portfolio report and look at your allocation, my allocation of all of my buying power right now is 30% in ES.
Beautiful.
30% of my buying power is ES, 24% oil, 13% bonds, and then I've got gold and the Aussie dollar down around 5% each or something. So that's it. So I'm never, and this is high, I'm never at 30%. I'm usually in the 25% of my buying powers in ES. So I do spread things around.
Right.
So I wasn't really, that heavily, impacted last week like some people were. But I think some people are just trading way too big, and it was a good wake up call for people.
Right. Now the 2.5% from your all-time high on the net lick, it's absolutely nothing.
No.
And of course that's 60% when you're saying 60%, but you have portfolio margin, don't you?
No, this isn't a Reg T account.
Oh, Reg T account.
Reg T account with all futures, because it's all futures. Because I'm actually not trading anything but futures. I don't have I have TLT is the only thing in there, but I have it's only futures.
So trading futures is similar to trading portfolio margin. I mean,
very similar.
Very similar, and I mean on buying power, right? Buying power comparisons.
Yeah, it's going to be very, very, very similar. And because I'm diversified pretty well between oil and gold and ES and bonds, those are my big four, and then I have a couple strangles in the euro or the Aussie dollar. That's about it. So it's a pretty simple, easy to run portfolio. And this is my best month of trading ever. So we'll close today, unless the market reverses and goes 180 points lower, which still wouldn't really affect me. We would have to drop about 300 to 400 points today by the close. Now, Jerome Powell could say anything this afternoon. Who knows? But I don't think he's saying anything.
No.
It'll be my largest realized gains month ever in trading for the last 30 some odd years. So
what percentage would that be?
Because
I know you target between 1.5 and 2%.
We're about 5%, but the account's larger now, so it's a 5% gain in a larger account. So we're up almost
5% is
4.9%.
5% in a month. That's
and
that's
I didn't
incredible.
do anything crazy, and I didn't.
It's incredible.
I didn't do anything different. I didn't go to like 70 or 80% buying power. I stuck at 50% buying power. I was on vacation for a month or for a week. Wasn't really doing much of anything. I would just check in to make sure that nothing was going to get stopped, and I didn't add anything. As soon as I hit 50%, the shutoff valve goes, and I tell myself, you can't trade until it gets to 49.9 or something like that. So it was a 5% month, which is good. It's not maybe day trader money, but I'm up 28% on the year, so that's good. So we're cooking along nicely and not doing anything crazy. Just trying to let compounding and let the trades go.
What's your Venmo? I want to wire you all my money. I want to just play pickleball.
I'll give it to you after the show.
That's congratulations. That's incredible. I'm more conservative. This is one of my big months, 1.7%, and to me that's humongous because I'm normally at 1.2, 1.3%. So to me, going from 1.2 to 1.7, believe it or not, it's a big month.
It's good. And even in my IRA, I'm going to be at about 1. I think it's 2%. There's maybe 1.7, 1.8%, because I'm much more conservative there. I'm trading 111s, not 112s. Right. I have less notional. I have less naked puts on. I don't do much else. I keep it very, very, very simple, and I'm only shooting for 1.5% a month. That's my goal, is 1.5% a month in my IRAs, and even in my PM account, I'm only shooting for 1.5% to 2% a month, not 3% like I am in this trading account.
Right.
Because in a PM account, it's much larger. I don't need 3%. I mean, it would be nice, but if it happens, it happens. But I'm really only shooting for like 1.5%, 2% at best.
Right. And you mentioned that when your buying power goes to 50, you turn off the valves. So when your buying power went to 50, 55, 60, what were you doing back then?
I just didn't do anything. So just no new trades. Just
No new
manage what
trade.
we have on. Yeah. So as soon as it hits 50, 52%, something like that, I mean, I don't add any more trades. Today I was at 49%, so I shot out a strangle trade. So now I'm at 52 or something. But so I'm done again. So I won't add any new trades over 50% is my rule.
Right. I don't want to give any recommendations to someone who just made 5% trading conservative, but wouldn't it be great to stay at like 45 in case the market has a big down move? You can put in a lot more trades.
Possibly. And I have a little overweight in Bill, the Treasury ETF. So if I needed to, I could get rid of some of the Bill and free up buying power to trade. So technically, I'm in good shape because I have a lot of Bill. And I've actually increased my amount of Bill this month. I'm also I kind of watch my trades, and I'm sitting at a couple trades that are very close to closing as winners. So I have some that are like in the 40%. I shoot for like 50% on strangles, and I've got some strangles at I've got one at 30. I've got another one here at 30. Another one at 24. I've got another one here at 27. So I know that some of those are looking to close soon, so I'm not as worried. But yeah, if we drop and there's some good deals out there, I will unload some of the Treasury Bill ETF, and that'll free me up some buying power to put some additional trades on. I will take it back. I actually did add a trade in ZN today, the 10-year bond.
Yeah.
So I put credit spread on bonds. I'm very bullish on bonds, especially the 10-year. I don't think they're going to lower rates today, but I'm pretty sure they're going to lower in September. And I really think that at least the shorter end of the curve, the 10-year and anything less, I think those are going to benefit. Bonds are going to rise. Rates are going to drop. Bonds are going to rally more. And the 10-year looks pretty strong.
Yeah, I agree with you. The yield curve is going to steepen. The front end is going to go down, and the back end is not probably going to go down that much.
It's not going to move as much.
There's a great product called IVOL, I as in India, VOL, which is like an ETF that run by a very smart woman who plays the steepener. So IVOL is doing really, really well, and I buy it occasionally, especially now. Now is maybe I would wait for a little pullback on IVOL, but it has had a good performance, and IVOL is a product that actually does exactly what you're aiming when the curve steepens. IVOL does well. So I wanted to share that product.
Is that the symbol is IVOL?
I as in India, VOL.
Yeah. So the quadratic interest rate.
Quadratic. Yeah.
Got it.
This girl who manages I've met this girl a couple of times in Connecticut, and she's very smart, and she also trades around her position, but it's mainly a steepener. If you think that the yield curve is steepening, IVOL is a product that people should. If that's your assumption, it's a good product to be trading. I think the IVOL.
I'll take a look. I'll definitely take a look. Because it is my assumption that rates will drop.
Yep.
For sure in September. I don't know if he'll hint at anything today, which is what I think the markets are expecting, which is why they're up. But I'm sure he's going to be a bit dovish today. That they're going to make a move this year, and that move's probably going to be in September, which I think. Well, I'm not going to wait till September to put in a trade when I can take the benefit of it now. Put the trades on. So. I'm actually up 8% since the morning, which is not a big deal, but it's just one of those bounce things. But I don't expect that to last. But I just put on a put credit spread in the 10-year note. or 10-year bonds. So
Yeah. If you're looking at a long-term chart of eyeball, what I like about an eyeball, like put on like a 3-year chart of eyeball, and
yeah,
you can see when they were raising rates how eyeball got totally destroyed because the yield curve was inverted, right? Was inverting and then stayed inverted. So here we can clearly see that 3 months ago exactly, uh, it stopped. The inversion stopped, and the market is thinking that this is going to steepen. So you can see the little dip. I have a monthly chart of eyeball,
yeah,
and the
that's what
last
I'm
three
looking at
months,
it monthly here.
so you can see the little the way it's it's bouncing over there. So it's very
Yeah.
interesting. I like that product. Another product that I like to buy when everybody's crying, and in fact, I have a I have a company who I used. I named it because it's my favorite product. It's called SVXY. Let me see if I can share my screen a little bit. And SVXY,
Yeah, the
because we're
VIX short
chatting.
term.
Yeah, I wanna see if I can share share my screen with the window. Here we go. So SVXY, and there's two products, UVXY and SVXY.
Right.
So UVXY has negative theta, and it's a product that I really don't like. I kind of hate UVXY. UVXY is it's a terrible product because it has negative theta. But SVXY, it's a volatility product, uh, very short term, based on futures, but it it has positive theta. So when the market goes down hard, it's an alternative to selling puts on SPY. You can either sell puts on SVXY, or you can buy SVXY outright. And I like that product so much. I've been using it for the last 4 or 5 years that that I'm I named a company after that. So I that's another product that I wanted to share with you to see if you wanted to add them to your arsenal.
I'll take a look at it.
Yep,
I
yeah,
typically
and
don't do anything with like VIX or any of that stuff because
uh,
it's so
but
expensive. Number
mm,
one, so VIX is expensive. I can't find a trade that works. You got to
yeah,
hit it exactly right. I just don't like it. I don't like trading
okay.
VIX.
This one, if
But
we
this
take
one
a look
maybe.
at the puts, if you just sell puts on it, let's say today, of course, not the day to sell puts
It's
on it.
got upward drift. So
It has upward drift, and when it goes down, you can either buy the product or just sell puts on it. Boom, and just a naked put. And if you get assigned, that's great. Then you own more as VXY.
got it.
So,
Yeah. So it's a
and
short VIX.
it's a short VIX, and it reverses much faster than the. Let's say you sold a naked put on SPY. This will pay the payout for this product is much faster than a naked put on SPY.
Mm-hmm.
And because of the value, it's only $59. It's it's less capital intensive.
Yeah, I
So
like it.
this is,
Take a look.
yeah. Normally, I hate volatility products, but not SVXY. So yeah, it's good that we shared a couple of new trading products that you can keep an eye on. I know it's normally it takes a while to when someone else recommends something that's not on your evoked set and your set of things to bring it into the fold. But I'm only sharing with you the ones that I
Yeah, no, I like
really
it.
like.
I'll
Thank
take
you.
a look. I'll take a look.
So
So that brings up another quick one. So let me just
yeah,
jump off on that.
yeah, of
And
course, of
this is
course.
another thing I saw, and I did a video on it. And I've done this a couple times, but I call it chasing the shiny object, which is essentially, somebody mentions something. I'm not saying your SVXY thing, but somebody sees it, it takes me a while to integrate something. So I'll have to look at it. I'll play with it. Maybe I'll put a trade on and I'll do some other things. But a lot of people just chase the shiny object, and it comes up a lot, because there's people on YouTube, there's people on Twitter, there's people on Facebook, and they're posting their trades and they're posting these giant wins and everything they have, and people jump from one thing to the next, because Tony's doing this. I guarantee tomorrow there'll be people buying puts on SVXY, so they're watching this. So it's all good, folks. If you're
hopefully
watching,
they sell puts, not buy.
Or buying or selling put. Who knows what they'll do?
Who knows?
Because they don't have a plan. All they do is they see something and then they don't have a plan. So some will buy, some will sell because they have no clue what they're doing. And then they'll look at, SPY. He's doing this on SPY. I'm going to do this on SPY. Or someone's doing this black swan hedge, or somebody's doing this other hedge, and I got to try this thing and that thing. And I'm pretty set. I mean, I certainly experiment and look at all kinds of things. And I will do some back testing on some things, but for the most part, I can only learn if I put real money to it.
Right.
And I got to put small though. Okay, so I'll do some small trades just to get a sense and a feel of how it works. And then you got to figure out, how does that fit into your plan? So I'm big on plans and telling people to have a trading plan, follow your trading plan. I'm robotic about it. It's not that anyone else's plans aren't right. It's just, this is how I trade. I'm comfortable with my plan, and I want to be consistent. I'm not shooting for 10%. I'm not even shooting for 5%. If I get 4%, I mean, I'm ecstatic. Okay, but it's not because I did anything outside of my plan to try to juice my portfolio. It's just, hey, the trading gods smiled on me for the month, and instead of a couple losers and a lot of winners, I had no losers or something, and a lot more. Whatever happens, it's all good. But I do I love these little ideas, so I'm always looking.
Yeah,
but
SPXY, I think once you start understanding it, I think it's going to go into your trading plan, and but only act on it. It's also a great buy and hold product, but only go into it on down moves. On down moves, I would either buy it or sell puts at it, and you know what I also like about it? Let's say your portfolio is getting to the max size, right? But you want to add something, and if you add one more trade, it will put you over the top. And so you could sell a small amount of puts on SVXY, and it will just be a little sprinkle, and because the size is very small, very very manageable. So you can use SVXY to when you want to add something, just a little extra, when you have a frozen yogurt and you want to add the sprinklies on top. Exactly, you can do that. Yeah. And I also like to, I've never been assigned on my SVXY puts ever. And I want to get assigned because I want to, the real money. I have a friend, Antonio, he's the best SVXY trader I know. He owns, I'm not kidding, millions of dollars of SVXY long, and he just mints money just by staying long SVXY.
So how long, if you're selling puts on SVXY, how far out are you going? Are you doing something that's a month or 51 days? Or are you going out further than that?
So normal, the 45, 50 days. So this is, for example, I would sell maybe the 57 puts on SVXY for September. Of course, today's not the day to do it, right? But because it's a huge up.
If the VIX has a little bit of a decent up move day or something, or a couple up days, then you can certainly sell it.
Yes.
I mean, really, you're only a couple days off from it hitting a pretty good low point. It went down to almost 56.
Yeah, actually, I bought SVXY around 56 and a little bit more outright long stock on SVXY.
Oh, that's good. It's decent premium. It's not bad. I would definitely want to do it in a PM account.
Definitely, yeah.
But it's a hard to borrow, but it's okay. So,
and if you already own some SVXY, you can get extra a little bit extra juice if you sell covered calls against it.
Right. Yeah. Sounds good.
So it's a new product I wanted to bring to the table that is very, very conservative, very, very conservative. And and I hope people don't start selling puts on SVXY tomorrow unless we have a huge down move. Like you
Exactly.
said.
Oh,
Now,
but I'm sure plenty of people will do that. So it's all
okay.
yeah, it is what it is.
Now you manage a bunch of traders, right? So I'm curious, how nervous did people get on the little down move, or not really?
So a good handful, and mostly newer people. So mostly newer people that are coming from outside or are just starting to get integrated into it. Most newer people, you can tell, oh, my portfolio is red today, or I'm down, or I'm down 5%, I'm down 7% this week. I'm like 7%, and holy moly!
Holy shit! Yeah, exactly.
I'm like, let's look at your portfolio quickly, and most of it was you're oversized. Number one, but I'll tell you, one of the things that I really focused on last week with members, and I put a video out on it as well, is I want people to not look at their net lick. Okay. In fact, I want you to take it. I just want you to block it off on your screen. So if you're in your Tasty Trade account, don't look at your P&L for the day. Okay. Stop looking at your daily P&L. Okay. We're not day trading here. If you're day trading, it's one thing. Okay. But
Right.
stop looking at your P&L every single day, folks, and you're going to drive yourself crazy. Okay. I'm a premium seller, and I'm typically out 60, 90, 120 days on most of my trades. My daily P&L doesn't really matter. The only thing that matters to me are the individual trades, and I'm managing the individual trades. And if all of my trades that I'm managing, like I said, I'm having the best realized gains month ever this month. But all I cared about was, I took a loss. I lost on a hedge because I always lose on a hedge because
Of
hedges
course.
I hate hedging, but I just do it because it's a necessary evil. And I'm trying to be responsible for people out there to tell them at least I'm hedging and I'm trying to be responsible. But so I always lose on hedges, but I did lose on a ratio spread on oil or something. But my portfolio didn't go down 10%. It just goes, I'm just looking at individual trades. You're going to go up a couple percent a day, down, and the larger your account gets, the more it's harder for people that have like a $30,000, $40,000 account. Once that thing gets up to 500 or a million account, and you start having 1 or 2% down days with the market, okay, that's a big number for a lot of people to digest. And now they're freaking out because they've never seen themselves down $10,000 or $20,000 in a day. I mean, heck, you were down, decently on that one trade.
Yep.
But don't look at the net lick. You just look at the trade, and I either win or lose on the trade. If I'm not near my stop loss, I'm really not worried about what the net lick's going to be. If all of my positions are down, but they're only down 10, 20, 30%, as opposed to I don't stop out till I'm down 200% on an individual trade, which would be a 2x loss for me.
Right.
And I sized all of my trades to be at no more than 2% of my net lick anyway. So I'd have to have 5 trades completely stop out at a max 2x loss for me to drop 10% in my account.
Right.
That's a lot of trades to be losing on. Now, it doesn't mean it can't happen. Market could go down 1,000 points tomorrow. Who knows?
Yep.
But the thing I want to make sure people are aware is don't look at your net lick daily. Just shut that off and just focus on your individual trades and manage the individual trades, and you're going to be fine.
Now, Tom, do you remember the last time you were stopped out on a 112 or a 111 for a loss?
Never on a 112. So it has never happened.
Never. Okay.
Knock on wood. But
Okay.
111, I did get stopped out in one of them, or a couple of them. I think it was 1 or 2 in 2022. And the reason that the 112s I didn't get stopped out on was because I'm farther away. I'm a lower delta on a 112, so 2022 was a bearish year, but it wasn't
Yep.
like a disastrous year. Okay, it
No.
was just that I love that year. If I could redo 2022 every year, I would, because
Yeah.
my style of trading, I made
Me
like
too.
82% that year. So I would love to redo 2022 every single year for the next 10 years. I would be set that way. A slow grinding 5% a month year would be beautiful for me. However, with a 1-1-1 trade, I did get stopped down on one in 2022, mainly because I have a higher delta, because you're trying to make at least some money. So because you don't have the 2 naked puts, you got to go with a higher delta, closer to 8, 9 delta, maybe 10 delta.
Yeah.
Like and one did stop out. It might have been timing or what have you, but that was it. So really, they're pretty resilient.
And when you talk about hedging, what is your hedge trade, or how big do you hedge? I'm curious about that.
Right. So, and with hedging, I'm very careful on hedging, because to me, it's a cost of business. So trading is my business. Okay. And you have to buy insurance. Okay. And so every business needs insurance. Okay? However, your business insurance it's like buying life insurance. Okay. And I hope no one's going to get offended on these things, but if you're 10 years old, do you need life insurance? Well, no, because what are you insuring? You don't have any assets. Okay?
Right.
If you're 80 to 90 years old, what are you insuring at that point? Are you insuring? Do you have a lot of debt that you still have to pay off at 80 or 90? Most likely, you probably don't. Okay?
Right.
But if you're in your 30s and your 40s, you want decent life insurance, because I've probably got a mortgage, or you've probably got car payments, and you've got your kids' education, and you've got your spouse to take care of. So you need plenty of life insurance. So I equate the same thing with trading. So I only hedge what needs to be hedged. And for me, the only thing I'm not hedging my whole portfolio. I'm hedging my ES trades. I'm not hedging oil. I'm not hedging gold. I'm not hedging individual trades. I'm hedging my ES naked puts. And what I do is, because I typically have a 2x stop, is I add up all of my naked puts.
Can we do it like on the trading platform? Let's say you have 10 naked puts on ES.
Sure. 10 naked puts on ES.
Yeah.
And let's say the average is like 60 days or something.
Alrighty.
Some are going to be at 120, some are going to be at 60, but let's go out 60 days.
Where do you want me to go?
So let's take the September 30th expiration, and then let's go on that. I'm going to give you a good example here.
Okay.
I'm going to look at.
So we're
maybe
pretending
something around 4,600. So take a look at 4,600.
We're pretending we have 5 112s on. So that's a total of 10 naked units on ES, right?
Yes. 5 112s. Let's just
5 112s, 10 naked 10 naked puts.
Okay. So what do we got?
$7.
I mean, let's start again. Let's go to 120. I'm going to do it a different way. Let's go to 120 days really quick.
Okay.
Sorry.
Okay.
121 days. I think there should be 121 strike.
Yep. This is the November.
Let's go to 5 delta.
5 delta. Yeah. All right.
Because that would be typically where we're putting our naked puts if we're opening a new trade. So let's just do it this way.
So the 44.50.
Yeah, which is roughly what, $17 or $18?
$17. Yep.
Yeah,
$17.
It's always $17 is pretty much the typical for me. So I can't even see the screen, but I know. All right, so $17, and I'm going to buy 2 of those.
Are you able to see my screen?
Yeah, I can see your screen. It's just a little small, so
sure.
My eyes are not as great.
No.
So
it's $17.
Yep. Okay, and there's always going to be 2 of those per trade. So let's take 10 of these. So 17 times 10.
So you would buy 1 for each naked unit you have?
Buy 1 what?
You would buy 1 long put.
Oh, so let's figure out what the total loss would be. So let's assume I have 5 trades on.
Yeah.
Okay, so that would be 10 contracts.
Right.
At 17. Okay, so 10 times 17 times the 50 multiplier. means I would have collected $8,500.
Right.
Okay. At a 2x loss, I'm going to lose, if they all stop out, I will lose $17,000.
Right.
Okay. So I need to find a hedge that's going to pay me $17,000 or close to it. Okay. Okay. So that's how I'm hedging. So I want to find something that's going to possibly pay off. And I'm going to assume, now these are the assumptions because we really don't know how things are going to act.
Right.
Some trades that are older aren't going to get stopped out. Some trades that are newer are going to get stopped out quicker.
That's a good point. Newer trades will stop out, but the old ones have already...
They've already decayed quite a bit and they're pretty far away. But let's say they all are going to get stopped out in a couple days.
Yeah.
So I want to protect at this point around $17,000, right? So I will typically, right now, the best way I've found to do it is I will go out to a 14 DTE. So let's go to 14 DTE.
Okay, let me close this thing down. Clear. 14 DTE.
Yeah, let's go pick 14 days.
Okay, here we are, August 14th. Yep.
And let's go down to something that's around the $5 mark. So what's going to cost me $5?
$5 would be maybe this one, the 52.40 or 52.50.
Sure. Yeah. Now 52.50 from here, because we're at 56.22, is a $372 down move.
Yep.
Okay. I'm trying to hedge what I'm thinking is going to be like a 10 to 12% down move.
Yep.
Okay. But I'm going to probably go out to what's the delta on those since I'm not
6.
Okay.
6.
So somewhere around the 6 delta-ish or something. But these are 372 points from here, which is about, it's almost always about 7% down. So I'm looking at something that's 7% down because even though 10% is where I feel I'm going to probably start losing trades around 10%, the 7% down, it'll start paying earlier on it. And typically I'll buy about 0.25% of my net lick worth of these. So I'm going to I spend about 0.4% a month on hedges. Now,
let me ask you, do you match units versus units or no?
I match dollars. Okay,
dollars.
So I'm trying to hedge dollars, not units.
Okay.
If I wanted to do units, it's going to cost me more, or I'm going to have to go lower delta. Otherwise, it's going to be too cost prohibitive.
So
I like a lot of units because really, the more units you have, as vol spikes, you're going to get paid even more for more units than less. And I'm not trying to make money. I'm just trying to offset my losses for the most part.
Of course. Yeah.
So I'm probably going to buy. Let's say we buy 2 contracts of this, and assuming that I have 5, I'll probably buy about half, not even half, probably less, but let's say I buy 2 of these.
2 of these is $500, $575. Yep.
Okay, let's just use that. Okay. If you go to the Analyze tab, so let's analyze what would happen on this particular trade. So I don't know if 2 is right. I'm just kind of guessing here, but let's take a look at this. If the market goes down, so as you shrink this and you guys just move all the way over.
Let me shrink this. I'm trying to shrink it.
And then you hit the little red dot on the far left at the bottom there. Go down. You see click that dot and it'll shoot right to the strike.
Okay. It didn't shoot, but
or you can just scroll your way over there.
Yeah, there we are.
Okay. All right, now we're getting there. All right, so let's assume the market goes down 10%.
Yep.
56.22, 10% puts us around 50.50, something like that.
50.50, around there.
Yeah. So what is this paying me?
$23,000.
Okay, so I've more than offset my losses.
Yep.
My losses were going to be 17. That's without a vol spike. I may not even need 2. 2's probably overkill here. Probably 1 would do it. What would 1 contract be?
1 would give you at 50.50. It would give you about $11,000.
Okay, So let's go back to now. Let's increase the volatility here. Don't get out of this trade. Go back to the on the trade tab there on the.
Mhm.
If you bring that sidebar over, there you go, and then we go down to make sure we click off the use per contract IVs, and just crank that up, crank the volatility up. I don't know, 10%, 20%.
Let me see, 10%.
Okay, now what's it paying me?
Now
This
it's
is a
paying.
10% increase.
Let me see. It didn't bump it up too much.
Should have moved it.
Should have moved. I increased it 10, 11. You see, I'm increasing it, but it's not.
Yeah, I wonder why. But it should. It obviously that should bump it up more.
Of course, it bumps it up because yeah.
So it
If
will probably close to double it. So
of course, if you increase the volatility 10 points, which would take us like to 20 some vol, that trade would pay you 20 some $1,000.
Right. So which strike did you use?
The 52.50.
Okay, 52.50, and we bought it, right?
We bought it. Yep.
So if I look at it really quick on mine, because I don't know, maybe there's something goofy, but August 14th. Yeah, if I bump it up like 10%. Okay, so somewhere around, what did we say, 50, 60?
50. Yep. Mm-hmm.
Yeah, if we drop down there, yeah, it still didn't move a whole lot. But yeah, it's like
No.
$11,000 or something like that.
Yep.
On it. So, maybe we need a little bit more of a vol spike, maybe 20% or something, pays a little bit more. But either way, I paid for almost all of those losses with one put.
Now, you always have hedges every 14 days out, always?
Yeah.
Oh.
Yep. So this will die, and I'll put another one on. And I'm allocating typically about 0.4% a month. So, which is about 5% a year. So I'm going to take 5% of all of my gains for the year, and that's going to be hedging. So, but if I'm shooting for, again, this is not in an account that I'm shooting for 1.5% a month. This is an account that I'm shooting for 3% a month.
Right.
If you're shooting for 1.5% a month, I'm probably not even hedging at all.
Now, do you estimate it based on extrinsic? Let's say you collect $1,000 of extrinsic. Do you take a percentage of that extrinsic and invest it, or you do it based on? I'm trying to figure out what's your formula in your mind to know how much money and where to place those hedges.
I think I've just played around with it so much, but typically I take all of my naked puts.
Yep.
I multiply by 2. I take all the income and I find out what that amount is. I also figure out what I want to spend. So I know that I want to spend about 0.2% a month. I kind of like that 7 delta range. So I'm typically buying as many of these puts at 7 delta as I can. And then I will look here to make sure that in a 10% move, it's going to cover me. Otherwise, I'll make some other changes. I mean, you can go down to 3 or 4% or 3 or 4 delta, or go down to like a 5 delta and add more contracts. That will also help you as volatility spikes a bit more because you have more contracts. But I find that if you try to match put for put here, you're going to have to, to avoid spending all of your money, you're going to have to go really low delta, and then you're too far away for it to do anything.
Right. And do you ever take profits on those hedges?
Typically, no, because they're there for one reason and one reason only. That reason is to cover my loss. Now, if one of my rules is if they quadruple in value, I'll look to take it off. But what I would hate to do would be take off a hedge and then have the market keep going down.
Right.
So yeah, it's just such a personal, tough, non-mechanical thing, which is hard. That there's just no perfect mechanics for everybody. I know some people love the black swan hedge thing where they're selling, 5 or selling 3 and buying 5 and whatever. And what we noticed too with some of our members, they've lost some money on those this month, because if the market goes into a slow decline, those naked puts
they're
that
expensive.
you sold to pay for the long, they're gaining in value. They're not decaying.
Right.
And now you're not building this long put wall. You're actually losing money, even though you have long puts. Those naked puts, those 3 nakeds compared to the 5 longs, they're not decaying. They're not coming off. So you're stuck with the only way the black swan hedge thing works is if all of your naked puts go away and you close them for very little, so that you have all these long puts on, although the long puts do expire as well. But if you have a slow grind down, something like last week, it's not gonna help you. So I don't like it. I just assume pay for it. Plus, my last thought on hedging here is the black swan hedge is essentially you sell something so that you can buy something. I just don't want to sell these naked puts to buy my long puts. I'm just going to be selling all of my other stuff, and I'm just using the money I'm already making to buy my long puts. So either way, it's not free. Everyone says, "Oh, the black swan hedge is free." Well, no, it's not. You had to sell naked puts to pay for your long puts. Either way, you still had to sell something to buy something. It's not free. So I just avoid specific trade of the shorts, and I just use the money I'm making. So.
Now, after you put them on every 14 days, but at day 10, their protection power diminishes quite a bit, right?
Could be, depending on what the market's doing, though. So yes, on day 10, the protection power could diminish if the market's moved up in 10 days, though. 10 days is not like 30 days.
No.
10 days is not a long time. The market may not have moved up that much, but the market could also move sideways. Like right now, I do have some on, and the 14-day it's down. So the 14-day hedge is down. It's only got 2 days left, so it's about to die.
So it's half a percent of your net lick on something you expect to make 2% or 2.5% a month.
Yeah.
So it's like 25.
Well, I'm shooting for 3% a month in my trading account.
Oh, okay.
So I'm okay spending 0.4 or 0.5% a month out of the 3. Yes, it's a hit, but it does provide protection.
So it's 16% of your credits, let's say, because 0.5 of 3 is 16%.
Okay.
So I'm trying to do the math. So if you collect $1,000
at the end of the year, it's going to be 5%.
5%.
At the end of the year, I'm going to reduce my yearly gains by 5%.
Yeah. Okay.
But if I'm making 30% a year, then I will be okay with 25. If I'm making 25% a year, I'm okay making 20%. Okay, and sleeping at night and feeling pretty good. But if I'm only shooting for like 1.5% a month or something, I don't really think that you need to be doing that.
No.
What about you? Are you doing?
No, I don't hedge. I hedge with my size. Nothing. No.
Exactly, because technically we hedge with our size. If you size properly and you keep your buying power under control, you don't need to hedge. Okay, but because I run a service, and I want to make sure members are smart, and everybody's panicked about owning futures and the black swan event, because so many of these black swan hedge posts out there have freaked everybody out. And so now everybody's like deathly afraid to trade futures or SPY or something like that. Yeah, stuff goes down, stuff goes up. Just size it properly. But what if, and then the argument's always, well, Tom, what if you can't get out? Well, then it'll be a little bit bigger loss, I guess. But rarely, knock on wood. So I'll just sent my dog into outer
Even the
space.
dog got scared there.
Yeah, so the dog thinks that the world's ending. But you can get out at some point. Okay, there's going to be a break. You can get out. Okay, I don't expect that the market's going to zero to overnight.
No.
So I'm more worried not about a black swan that happens every 20 years. I'm more worried about a 10% down move that happens every couple months potentially, or every year. I'm sorry, every year or so.
Right.
But yeah, I don't like hedging. I'm with you. I think as long as you size properly and you have a plan to stop out and you adhere to that plan, I think you're fine.
Yeah, I don't hedge because I don't mind even rolling puts to infinity, because every naked put that's out of the money, if you have enough capital and enough time, it has never been a loss.
Right.
In the history of mankind, right? But you need time, you have to be alive, and you need capital to hold it. But as long as you can roll that naked put and you have time, then that's why I don't hedge, because I don't mind owning SPY or owning, of course you cannot own SPX or ES, but you can roll it to infinity, right?
Yeah, you can keep rolling the underlying futures contract. However, you're going to maybe lose some money on your rolls because their contracts aren't the same. But I agree with you on SPY. So in my PM account, I'm trading SPY. Now you need to have the cash on hand to take assignment on SPY. But if you have PM, the margin power is not going to be much of an issue, and you just need the cash to be able to take assignment on it. And I'm totally with you. And I agree with the philosophy of he who dies with the most SPY wins. So I'm all good on give me SPY, and I will take assignment on SPY any day. Maybe I'll stop. And if I would lose on 10 SPY naked puts, maybe I would take assignment on 5, and I'd stop out at 2x losses on the other 5. Okay.
Right.
So I might pick, depending on your cash amounts or something. So maybe I'll stop out on some of the newer ones, and I'll take assignment on some of the lower strike ones, and then I'll wheel my way back out of it if need be.
Thinking out loud, let's say you took a loss on a 1-1-2 trade, right? And you have your hedge on, the hedge is working. What you could do right away is put in a 1-1-1 trade, better positioned, maybe more aggressive for the same credit. And because that trade is going to be better positioned and a better credit than the previous one you had. So that trade could offset, you would have less units and the same credit. And so you would keep the dream alive with less units. I'm just thinking out loud.
Yeah, sure. And if you're getting stopped out on a 1-1-2, the market has gone down 15%, or 10%. So you're putting on a 1-1-1 at a pretty good, probably high volatility, getting great premium, not having to go as high on the delta, and you're already down 10%. So even if you're 10% away from the money, is the market going down 20%? Well, it could, but I think it makes sense. That's why I just will keep putting that. I'll just keep trading.
Right. That's why I was saying. So the best time to put a trade on would be like when you get stopped out of a 1-1-2, because the market's just ripe for naked puts at that moment.
Right. And that's why in 2022, in that down market, I wasn't getting stopped out, but I was hitting a lot of the put debit spread trap thing. So the put debit spreads were just paying off. Like, I think it was something like 25-30% of the 1-1-2s. I made more than 100% on. I was making average 2 to 250% on each 1-1-2. 25% of those, because we just kept hitting the trap and hitting the trap, but we never hit the naked put, so we never got stopped out. And I was just holding them till the end and cashing them in a couple of days before, and it's all good. You just got to stay calm and trade your plan, but you got to be sized properly, and you got to have a plan on when to stop, and that's it.
What makes you a great trader, Tom, is your 50% rule. I love that. You're spending 15%, 17% of your credit to hedge your portfolio in case of, the shit hits the fan. So even though you're a much more aggressive trader than I am, you are a smart trader because you're controlling your size with your buying power, and you are protecting the outlier, the black swan. So those I for everybody watching this podcast, I would go down back to the around the 40-minute mark and rewatch this, because this is trader gold that you gave today in the podcast. And everybody should watch and rewatch and triple watch everything you said here, because you know those events are rare, but they do happen, and
Mm-hmm.
I've lived through a few of those. So if you guys want to trade forever, which I think all of us here want to, and you have to plan um, for those on those horrible events that will come up our way, and you don't want to have an event take you out and destroy your nest egg, or your hard work. Your 5 years of trading can be wiped out in 2 weeks, right? And if you're taking out of the game, you're out of the game, and then you cannot make
And
any more.
understand what what are you hedging? You don't have to hedge everything. Just hedge the ES or SPY if you need to do it. And also, just like life insurance, I mean, do you have a $5,000 or $10,000 account? I don't think I'm hedging it. I can rebuild
No.
that account. Okay.
Yeah.
If I'm hedging my retirement account, my IRA, and I'm going to retire in 3 years, and that's all I have is this IRA, then I think you should be hedging it. Okay.
Right.
If it's a discretionary trading account, don't hedge.
Yeah, what the hell? Yeah.
Yeah. Because it's discretionary. But if it's your life savings and you want to trade more aggressively and use futures and stuff, then probably should be a little careful.
Yeah, I couldn't agree more. I think this is a great spot to end the podcast. And everybody, Tom, can you remind everyone where can they find you?
So you can find me on YouTube under Tom King Trades on YouTube, or if you want to check out the trading service, it's Income Navigator. You can go to mrtoptick.com and check out Income Navigator service there, and join us there. Either way.
So everyone, if you want to grow your pile, follow Tom and Tony. If you want to protect your ass while trading, rewatch the last part of this podcast, because it could save your butts. And for everybody out there, thank you for watching. And remember, you gotta risk it to get the biscuit, baby.
Take care.
Hey, Tom.